Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I am Andy.
I'm Brian.
And it is just the two of us today. Dynamic duo. We're going to talk. Oh, man, so much has changed since last week. I actually brought last week's show notes, too, because there's a couple things I'm going to reference, and I want to make sure I say them right. But, dude, so much has changed since last week. The stock market took a massive hit. The bond market reacted very favorably, and mortgage rates, of course, had their own reaction, which we're gonna get into. Right away, though, we have to make a stop at CNBC, and we're gonna talk about the refinance demand.
Yep.
So weekly mortgage refinance demand soars 16% as rates sink to the lowest level in over a year. This is not just some fancy headline. I also want to make sure we're saying that no one is at the top of the mountain screaming, "Everybody come for a refinance!" Like, that's not possible for everybody.
No.
There are definitely some limitations. We'll get into some of that. But, I mean, look, this is one of the things that is the kind of outcome of the aftermath of the market sell-off, and I'll say a mini contagion, if you will, because it didn't really go full bore, but it is definitely a little glimpse as to more to come, probably, whether it's really rapid or slow. It is more of volatility to come. The average contract interest rate for 30-year mortgage went from 6.82 to 6.55 on average, and applications spiked for refinances. They went up 16% for the week, which made that week 59% higher than 1 year ago.
Oh,
so,
wow.
like, snapshot in time a year ago to today, 59% increase. And Brian, you have seen that firsthand.
Yeah, no, this last week we got a lot of influx of people that needed a refinance. And the reason being, I mean, I think it was a combination of a lot of different things going on. People finally say, hey, makes enough sense for me to be able to refinance. Two clients actually reached out and they're looking to wipe out all their debt completely. We're working on some cash out refinances. But one of the very particular cases I am starting to see is people that got buy downs maybe a year, 2 years ago, or inclusively even 3 years ago. That time is starting to come due, and those rates are going to start adjusting and going up to the what the actual lock rate should have been. And right now, I am getting a lot of people saying, "Hey, well, where are rates at?" I know when we last spoke, or when I last did my loan with the other person, they said in about 2 years things would start easing up, and that's what we're starting to see right now. So taking them out of the buy down and just solidify them into a fixed rate that's not going to move anymore. And the goal is to always keep them under the last year's rate, so they never touch that high rate that they were supposed to.
That's a great point. And I don't know if you were coming into this ready to talk about the buy down. I'm glad you brought it up, though, because the buy down is something that someone who maybe bought in 22 or 23 at an elevated interest rate, and at the time had it reduced temporarily because of the 2-1. Now that's coming due in 23 if you got it in 21, or if you got it in 22, it's going to be coming due. So that is a great example for where some of this refinancing might already be taking place because of that. I know there's other reasons, which we're going to get to later, but this is the kind of reaction you kind of expect from the market when you see such a heavy sell-off, massive selling, and you see the treasuries kind of follow suit, and I'll say weaken, but in mortgage terms, strengthen, meaning that mortgage rates go down. We saw a significant drop in mortgage rates, and even here, that brought people off the sidelines big time to save money. I mean, you go from having like 5-6 escrows to like 19 in a matter of 48 hours. That's a big deal.
No, it's starting to feel like, hey, we're actually working again now. Hey, we're busy. But in a sense, it's a lot different as far as, the solutions that are being brought forth nowadays compared to a few years ago. It's like now you really have to understand the file, really kind of provide a solution, because it's not just hey, let me just make this transaction happen. It's okay, the money's cheap.
Well, I mean, to really quickly make the point there, I mean, you're talking about like back in 2020 and 2021. Hey, your refinance is going to be 2.5. Duh, do it. Like just do it.
Anything under like 2-3% was like, okay.
I need to purchase a home. Oh, my rate's gonna be 3. Okay, fine, do it. Like, but this is way more. What's the word? I don't want to say like structural, but strategic, I guess. Maybe it's strategic is the way.
So a lot of the approaches that I'm taking is, really breaking down, the client's debt, how much they're paying over here in monthly recurring debt for the credit cards, their, monthly car expenses, loans, or whatever it might be. And then giving them the clear path of saying, hey, well, if you clear up this much over here, we're able to then, consolidate it over here and still give you a positive cash flow of X amount, depending on, what it is. And that's been, a lot of what the cases have been. in where it's like, yeah, I have like $1,200 in a consumer debt that I pay monthly, or close to $2,000, and I need to get rid of all those payments. So it has helped a lot that they do have that option of doing it. But the biggest thing for me, and something that I wanted to bring clarity to, is that whenever you see the average rates on wherever you look at a Mortgage News Daily or NBC, they're going based off of every mortgage that's being written across the United States. Now, one thing about mortgage rates is that it's driven by your credit score, your personal debt to income ratio, and the debts that you hold. So when you're looking at that national average, it really doesn't tell you exactly what your rate could be, because I will tell you from insider knowledge is that I've clocked some clients in under what the average is right now, and that's because their credit tiers are a lot different. My advice is that if you are on the fence, or you're not sure because you don't know what rates are at, or you still think rates are a little bit higher than what you would like them to be, talk to a mortgage professional and really just give them your situation and let them really guide you through that, because you're going to find a lot of clarity and you'll understand how things really work, and you might be in a better position to be able to do something with that.
Great point. And also to keep in mind too that they're talking about the conforming average, but conforming is there's still difference between conventional conforming loan limits, and then you have VA and FHA. They have different pricing in addition to the credit the credit strength of the borrower. So keep that in mind as well. Interesting about this though, despite the refinance activity broadly picking up, the purchasability was kind of like meh. It was like not as much of a reaction, and I think maybe that could be because of the perception that it might be temporary, or maybe it's just still not enough. I think it's maybe a little bit of both, from kind of some things I've been looking at myself as in news space, but also talking to people. Like it's kind of like, okay, that's a good shot in the right direction, but there still needs more to increase that affordability to get people off the sidelines.
Yeah, and another one that I've really been seeing a lot lately, and it's unfortunate, is a lot of divorce cases, and a lot of people finding now the opportunity to say, hey, now it makes sense for us to either sell the house or refinance, cash out, and split the equity. You stay with the house. I've been noticing that a lot, and I've started. There's a few realtors that I work with that have mentioned that, hey, I am starting to notice that, and people are starting to either make that decision of, hey, I'm keeping the house, you're getting the equity. I'm getting the equity, you're keeping the house. So that's also something that I have been seeing. And with the rates coming down, it pushes, a little bit more for that to be able to be done.
Well, I think that, for us specifically in the mortgage space, it's kind of like layer one. Oh yeah, that sounds great for business. But layer two, you have to look at what's behind that. Like this is real material impact in the lives of people who are homeowners, who are refinancing for a variety of reasons. And so our little experience here over that week is a microcosm of the broader trend where I'd say tens of thousands of people across the country are experiencing some sort of financial relief or gain by moving themselves into a lower rate lock than what they had in 22 or in 2023. So this is encouraging news to me.
Yeah, and look at it like, taking the elevator or the escalator. Right now you're just coming down. There's going to be another level to come down. So I think you should just look at, what it is you're looking to do in the long term. And I always speak about that because you can't really foretell what's going to happen in the now. But if you have an idea and a sense of direction, it's going to be easier to make a decision right now. And I think that's one of the toughest things for, a lot of consumers and a lot of clients, is that I don't know what's going to happen. Well, we don't either, but you can only account for what you can right now. And I tell my clients, if this is a solution that solves your problems right now, take it, because you don't know what's going to happen later on down the line.
Yeah, no, it's a good point. I think that advice is probably being given broad and wide and largely by the mortgage industry, of course, but I think it's being well received by homeowners who maybe have been silently looking for some sign of relief on the horizon, and now they're getting it.
And also on the flip side, not everybody is, right now at the right time to refinance. So
Correct.
Also make sure that when you're speaking to your lenders or you're getting quoted, you look at the paperwork, you look how much they're charging you, look how much, in origination and discounts, because some things I have been seeing from other industry members is that, the calculations on, you're going to get a lower rate, but it's also going to cost you this much, making the savings, not as favorable as they should be. So that's also something to be worried about. And if you don't know what that means, please reach out to us. That's what we're here for.
Yeah, and this might be a good a test run for you. If you're like, oh, hey, I missed this window, or maybe this is not the right window for me. Don't let the time pass and still be unprepared later. This would be a good time to then coordinate all your paperwork and make sure you got all your pay stubs in line. You got your bank statements all cleaned up and they're all in order. You have good, I guess organization is the best way to summarize my whole point here. Is like get all your financial house in order so that when the time comes up, you are ready to strike when the market is in your favor.
Yeah, 100%.
Well, let's talk about home buyers, Brian.
Yeah.
The next article from Housing Wire poses the question, will home buyers jump at cheaper mortgage rates? And I don't think that they will right away. They mentioned a lot of really good points in this article that would suggest we should see lots of people coming off the sidelines, but it's not happening. So real quick rundown, and then we'll break it down. So inventory rose as expected. New listings have ticked down, which is going to hold prices. Pending home sales are up, and home prices are down, and price reductions have also started to slow down, happen more frequently. So that begs the question: what is keeping people on the sidelines then?
So that actually kind of, how do I say it? So my thoughts on this is that people are still waiting for the market to drop more. And this is kind of like you said, that first wave. Now, what I do see happening, and I'm curious to see, is that I feel that as rates start dropping, it's only going to eat up the competition or the demand that's out there right now that still needs to be filled. So not until we have a drastic drop in rates or, a good amount of time that rates have been on the downtrend, that I feel more people are actually going to be like, hey, it's time to sell. Not buy, because we know the buy demand is there, but I'm referring to the sell side where I feel like sellers are like, okay, the rates are right there. Some are already starting to put more houses up in the market, but there's still those people that tank the rate to like two and a quarter, right? That are like, if I don't have to sell, I'm not going to sell. Why would I? So I feel until there's a significant drop in the rates that really gives sellers the appetite to want to sell, then we're going to start seeing a lot more inventory, and that's when I feel prices are going to start coming down. I don't think that they're going to happen in the next 6 months, maybe gradually and small, but not at the pace that we would like to see them. At least that's what I think.
Okay, so I'm going to kind of meet you there. And one of the things that they had said, someone was quoted in this article saying that the fear I have is that it took so long to get here that maybe home buyers have given up for the year and will wait to see what next spring looks like before entering the market again. There's a couple reasons for this.
That's fair.
The first thing is typically inventory plateaus in August and then starts to decline in September.
Yes.
So that's kind of a seasonal trend. A lot of parts of the country start turning the corner where summer is coming to an end. School goes back in session. And if you haven't moved by now, you're very unlikely to be moving in the middle of winter when it's snowing and you're dealing with weather. That's part of it in parts of the country. Last week, and this is why I brought my news from last week, is remember we had an article last week that we talked about, also from Housing Wire. Almost 40% of home shoppers are hitting the pause button until after the election. Which means that puts us all the way until November of this year. So I think you have part of what you're talking about, and you also have that there's 40% of at least the people surveyed on this other article from last week talking about, hey, I'm not going to do anything anyways until I know who the heck is the president.
And to that point, I really feel that and September, October, November are going to be very, like, how do I say it? I think strange times, because we don't know what's going to happen. If we see the rates come down in September, that's going to put a little bit more pressure on the real estate market and the rates. But up until I think we know exactly what's happening in November, that I feel things are going to spill over.
So it's all but baked in that the Fed's going to do a rate reduction in September.
Exactly,
I mean, I did not bring it for today to talk about because I think it's too speculative still. There was a couple conversations. Should they do a rate cut like right away because of the market mini contagion? And they did not. And then now the conversation turned to, well, if they're not going to do it right away, should they still only do a 25 basis point rate reduction in September, or should they make it 50? So now that's conversations on the table.
Right.
And I don't want to get like lost in the weeds on that, because I don't want, the broader idea here is what's going to bring buyers back. So I think September, seeing the Fed make that move will, I'll say psychologically or behaviorally get people to reconsider.
Yeah.
And then the other thing I'm going to say specific to San Diego, and this happens year after year after year to us here, and it's probably true at other offices as well, December goes off for us here in San Diego. I don't know what happens, but for some reason, December goes bonkers for us here at Mortgage Heroes. And then there's like a lull in January and like February a little bit. And then March. But it's like everything's calm in October, kind of slow in November. And then December hits, bro, and people are just like showing up all over.
Yep. No, I definitely agree. We've seen it these last couple of years. One of the things that I've also noticed, and they speak about it in the article, is that these last 2 years since 2022, October, maybe a little bit before October, rates start to go up. And last year we touched around 8%. In 2022 we hit the 7% range, which was the high for that year. And those years we were on the uptick of rates. Now, what the difference is from this year is that the climate's a lot more like, hey, everybody kind of knows that we're leading towards a rate cut. So I speculate that based on, that sentiment, October is going to be very different this year around.
I think it is because, and I mentioned this in like many episodes prior and a couple of times. Like October of 2023 was the hot stove moment.
Oh, horrible.
Like, we hit the stove 8%.
Horrible.
Woo, hey, everyone pulled back like, whoa, no way. We're not doing this or just mathematically can't do it. So I don't think we're going to have that again. I think we're actually kind of at the, kind of looking over the edge of the cliff. Oh, not the cliff. I'll say the mountaintop a little bit where we've come off of those 8s, hanging around 6s and 7s or so. Some of the VA deals I know we're locking are in the high 5s even now. On the VA Earl specifically. So just good disclaimer, the VA Earl, not the VA purchase right now, unless you have one. But we'll get to that in a minute. So I agree. You're going to see a different October this year. I think you're going to see a different November for sure because
of course,
if people are on the sidelines in between now and the election, and their person gets in, then I think November, December is going to go off.
Well, think about it. Somebody's person is going to get in November. So
that's my point. Whether you're for one side or the other, the point is if some people are sitting on the sidelines because they want to see if their candidate wins or not, and then they're like, oh well, when that happens, I will do. Well, that's the candidate winning is the first domino, and then the second thing is boom, I'm ready to buy. Let's go. That could cause a December for us that's just as wild as the ones in the past. I don't know. That might be too predictive at this point. But what we're seeing still is, despite these other headlines or these main topics of pending home sales going up, prices kind of going down, price reductions going up a little bit, and the median price is still about the same. And I think that the price reductions ticking up a little bit is a sign of people willing to make deals happen, number one. And I think the plateauing is happening. I think that the median home price is going to take a breather from now until maybe 3 to 6 months from now. I do not estimate it to continue climbing the way it has.
I'm with you on that. And one of the things I've noticed opposed to other years is that right now, since it's all about the affordability crisis, the offers that are going out aren't being like, how do I say, over the top, asking price. They're being offered a little bit above asking price to be able to get credits back. So I still see houses being sold a little bit above asking price to be able to get credits back. But I think that might just be, for the local real estate market. But
and the land attached to it. Remember, we talked about that a lot too. It's like it might be an older house, but it's on an acre. I could build other things there that create cash flow. So I will overpay for what's there now in order to build what I know could be there later and increases that value. So make sure I make that note too. But sorry, I know I interrupted you.
No.
But something else about price reductions?
Yeah, that was it.
No, that was it. Okay, so people are still, I'll say overbidding on the value in order to get credits back, and that's about to start another round, or another reason is about to kick that off, which is the whole NAR lawsuit thing. So we learned from last week's show in Friends of Mortgage Heroes with Stephanie Russell talking about the new forms. One of the things that could happen is that they're going to bake into your offer as a buyer that the price get increased in order to pay the buyer's commission if it already isn't priced that way. So that's something I think we got to look out for and kind of see what happens.
I mean, it's going to be interesting. Like, hey, well, we can't offer that much. We can offer this much. Like, what are you going to go tell your realtor? Or what's your realtor going to tell the buyer?
Right.
So interesting times. We'll see.
Well, I want to take that moment as a cool pivot point to go back in time a little bit, and we're going to pivot into an article from bankrate.com, and this is mortgage rate history from the 70s through 2024. Now, I am currently on set, the only one representing the 70s here because William isn't here, but I'm representing the end of the 70s. I was born in 79, so I only read about the 70s in history books. I think you were born in 2000 something? Okay.
I'm representing the 2020s.
I know. So we have a chart which I'm going to flash on the screen here.
Mortgage knowledge.
This is the 30-year fixed mortgage rate chart, 1973 through 2023. And this is very interesting graphically because you can see what is going on with the rate environment, and then I'm going to pair that with, you can see that related to prices of homes, economically what was happening at the time, and there are some really, really big differences from the 70s to the 80s, 80s to 90s, even from the 90s to the 2000s. So let's go through this piece by piece. Is that cool with you?
Yeah.
Okay. All right. So In the 70s, what you have happening here is the 30-year fixed rate mortgage was by that time the most popular type of home loan, and it started that decade around 7.3%, around 1971, according to Freddie Mac. And then by the end of 1979, what a great year. A lot of really cool things happened in 1979, specifically in the month of February.
I
think that's, I was, oh,
is that your birthday?
I was born. Oh, shoot. Anyways, by the end of 1979, oh, here's the bad part. Oh, I arrived. Bad part number one. Here's the second bad part. The 30-year rate went to 12.9%. So we started the decade at 7.3, ended the decade at 12.9. And during that decade, the Federal Reserve's expansionary policy and other factors helped drive inflation and borrowing costs way up. Now, those of you who watch our show who are better historians than I or lived through it with the front row seat, you're going to have a lot of the comments to talk about global competition. There was definitely, I mean, there was gas shortages. You had
the Cold War.
You had
was it the Cold War or Korea?
What?
Was it the Cold War during that time?
No. No, not really. No, the Vietnam War had kicked off in the 60s, and then you had a lot of economic policy that had to get, I'm going to say, corrected in the 80s that came from the 70s. Again, looking back in the history books. So the 70s certainly started seeing a spike, which you see represented on this chart, and they kind of peaked out there right as the decade changed from 79 to 80. So we get into the 80s, and in 1980, this is what I want to bring up, the whole median home price related to interest rate conversation. Is in 1980, homes in the U.S. cost a median $63,700.
That's a down payment nowadays.
That's the cost of, I think, like a Toyota RAV4.
Yeah,
A RAV4 hybrid. I don't know.
No, 4Runner's a little bit more expensive.
A Model Y, a Model Y, dual motor Model Y for $63,700. I'm sure there's probably some much cheaper than that now. But anyways, 1980, the U.S. cost of a median. No wait, U.S. cost. Oh my gosh, I can't say it right.
U.S. cost of a median.
Can you say it?
The U.S. costs a median of $63,700, according to the Department of Housing and Urban Development.
Now, only 10 years later, that median rose to $123,900. It literally doubled in 10 years.
Damn.
So
you should have bought it in 1990s.
That's
crazy. Well, what was I doing?
You were pre-gaming. You weren't even on your way yet.
I was like this.
Now, mortgage rates changed dramatically from that time then. They had a pinnacle of 18% in October of 1981. Can you imagine that? 18%? It's like a credit card. And then they kind of ended the decade at 9.7. So again, like that halving. So it's like it kind of doubled the median in price and then halved in the rate. So you can again see that on the chart. In the 90s, mortgage rates plunged to an average of 6.9. They say plunge from 9%. I'd say plunge was the 18 to 9 back in the 80s.
Jesus Christ.
Yeah, in the 90s, going from 9.7 to 6.9. Yeah, that's dramatic. But that was again over like a
that's what literally just started to happen here. We went from like 8 to like now 5s.
8 to 5. Yeah. So it's kind of similar in that way. But that was over a 9-year span. You're talking about 1990 to 1998, so 8 years roughly, but going down by 3%. Now, in the 2000s, this is when things got really nutso. You had 9/11 kickoff in 2001. The housing market and the subprime crisis happened. You had overdevelopment. You had all these crazy loans, the no income, no job, no asset loans. You didn't have any credit check in some cases. Jesus. It was crazy. Stated income. By the way, for those of you who might know, stated income meant income that you make but is not recorded on paper, such as tips, cash tips, and things like that.
Oh, it
didn't mean like name your income and then write that number down. Like you couldn't. Yeah, but that's kind of what happened. People go, oh yeah, I work for the post office. I make $180,000. Like, wait, oh, it's a stated loan. Yeah, sure. They make $180,000. They don't make $180,000. Jesus. Anyways, stated got abused. So the 30-year fixed rate around that time was about 8%. I remember writing some loans at 7.5% back in 2005, 2006. 30-year fixed at like 7.5%. But Brian, these are people who they bought a house in the 80s at like 16%.
So they're like, oh, this is great.
Yeah, it's 7.5%. I'm like, yeah, it was like the high at the time. But they're like, no, I'll take it.
See, that's I feel what the difference in our generation is that everybody's like, the rates were 2%. 3 years ago.
Yeah. Well, and we're gonna get to that because because of the great financial collapse, you saw the Federal Reserve and basically all the banks just do quantitative easing, i.e. flood the market with money and support and backstop everything. And then you got rates down to like 5.4% in 2009. But you had property values absolutely crash. I mean, there are parts of Chula Vista here that were down 53%, 57%. A house that was 500 was now 240. I mean, it's a massive collapse.
Should have been investing in real estate instead of going to middle school.
Instead of going to preschool.
That was middle school at the time.
2010s, of course, we had them dip into the 4% range. The Fed was still doing quantitative easing. We had some policy changes in the early 2010s.
So that's honestly what I wanted to make a pit stop there. So the quantitative easing is literally the reason why rates came down the lowest that they have been.
So it goes all the way back to Ben Bernanke, and there was a couple of things that happened. Ben Bernanke was the Fed chairman back at the time in the Great Financial Collapse, and basically what they had to do was make creative ways to infuse cash into the market. One way was to reduce rates all the way down, and the other way was to basically backstop banks and governments with bonds and payments.
Yeah.
So quantitative easing is the process by making money easier and cheaper to borrow from bank to bank overnight, and also ongoing. That's kind of like the easiest way to say it without it being too technical, without me getting like dinged in the comments for saying it not exactly 100%. So, but what that did though is it spurned people to borrow because it was cheaper to borrow. So, it's kind of like, oh, you make money when you lend money. Well, if you need to lend money to make it and people don't want to borrow any, what do you have to do?
Make it affordable.
You have to make it affordable. It's kind of like when you're a bank and you want to attract money. Well, what do you got to do for that CD? If I want to get $100,000 from you, can I give you a CD of 0.5% or 4?
4.
It's got to be higher, right? So in the same way, it's like if I want to lend money out, I got to lend it as low as possible so people take more of it. And then if I want to make money coming in, I got to give you a return that whets your appetite. So you go, oh yeah, I'll give you $100,000 and lock it up for 12 months. That kind of deal. So anyhow, that's kind of that's over speaking some of that. That's not what quantitative easing is. That's just the point of all these things were happening at the same time. In the 2010s, the Fed Reserve was buying bonds through the quantitative easing period. That's how they infused cash when I said that. And then that started to taper off, and that stopped. And then we get all the way to the 20s, and then a whole bunch of stuff that's been crazy has happened since then, which we've had a front row seat to. Even the Fed, once again, dropping rates all the way to 0 to 0.25%, creating different lending windows and opportunities for banks and agencies and other people to borrow money in order to prevent collapse. I think they did it in a very crafty way this time around versus literally bailing people out on the weekends back in the Great Financial Collapse. That was an interesting time. I remember there was a time when the heads of all the big banks were called to like Washington, D.C. for a meeting over the weekend. And like by Monday, it was like Bank of America buys Countrywide. Wells Fargo acquires something. Chase absorbs Washington Mutual Bank. I don't remember all the ones that
everybody's like, hey, you're taking them, you're taking them, you're taking. I don't care. You got him.
For real. And there's a lot of this on the internet, on YouTube. Yeah. So if you're watching this segment of the show, you'll probably go down a rabbit hole and go, wait a minute, what? That bank was offered what in order to take that? Yeah, these banks were kind of told you're going to absorb every single asset and toxic asset of this bank, and we're going to backstop it. So we'll help create a lending facility for you to borrow against, to buy it. You can take it over. You'll own it. You'll take and clean all the things that are dirty and keep all the things that you want to keep, but we're going to force this upon you as your good deed, which you'll also be able to self-aggrandize yourself with and make billions more dollars. So there's a lot of opinion on both sides of whether that was a good idea or not.
Then we wonder why things get broken.
Yeah. I mean, it's like if I just was sinking, and then memo comes in here one day, goes, "Hey Brian, you're going to take over all of Andy's monthly budget. But what I'll do is I'll lend money to you at 0.25%, so you can borrow from me to pay for his bills. But then you're going to have all the things he owns, and as much as you can hold on to it."
Oh, okay.
Yeah. So they kind of backstopped things that way. That's probably the easiest way to explain it.
That's a good way.
It's way more technical than that. Watch House of Cards.
So The Big Short too.
The Big Short, yeah.
That's a good.
So I don't want to go any further on this, Brian, because we have some more important things to talk about. But that was a really interesting kind of snapshot of mortgage rates through the decades. I want to end the show today talking about real examples. The market really selling off a week and a half ago, and then refinance rates coming down brought us to a place where a lot of people in our camp have been able to refinance, save money, consolidate debt, even just lower the mortgage payment for the sake of lowering the mortgage payment. Let's dig into a couple examples you have right now on what are people doing and what are ways they can that people watching could take advantage of what's happening in the market right now.
So I know 2 years ago, even last year, the buy down that we spoke about a little bit earlier was very popular, and it helped a lot of buyers ease into their mortgage payment. A lot of my clients right now are calling me back and saying, hey, we're at that mark where it's going to adjust to that higher rate. when we first initially spoke, we said, hey, the goal is going to be that we're going to monitor for 1 year, 2 years. And in that second year, we're going to look to make that refinance and solidify it at a lower rate. So you never go up to that. So a lot of my VA clients right now are calling me back. We're helping out a family, and they actually just had a baby literally on Friday, the day right before I gave them a call to say, hey, it's time to refinance. Wow. So for them, it was very special because they get to put a little bit more money back in their pocket going into the winter, holiday seasons, and then the baby in itself is not a cheap expense once the babies are here. So that's one that I'm seeing a lot of that. A lot of people are now coming back to refinance their buy down, and the good thing about that is that if you still have a year pending in there, you're gonna get that money reduced from your loan amount, so you'll get an additional extra savings. So that's one example that we're seeing, and then the most popular one is still right now the cash out refinance. And what I'm seeing is that, we were able to do a client that had a 5.875 and we literally just took them up to a 6.25, but they were able to take out over $92,000 of their equity to be able to dish out and pay. I want to say they have combined $30,000 in debt, and the rest are just going to keep it for their pocket. Their payment's going to go up maybe like $400.
Oh man. So they're taking roughly like 60,000 almost about that. And just kind of holding on to it.
Yep.
Okay.
And
interesting.
Then the rest is their payment's gonna go up, like I said, around $400. They actually opt out to not pay property taxes a month and homeowners insurance.
Oh, they don't impound it.
So they
pay twice a year.
Yeah,
okay.
So they have an even lower payment, and that's one of the things that I'm starting to see a lot. Where people with these rates that came down this last week is that maybe it's time for me to take that equity out and start putting it to use. Now, on the contrary, a lot of people are also looking at the HELOC route. But one of the things that I realized that is if you're using the HELOC to pay off your debt, you're not actually able to, cash that in for a tax write-off. The only reason...
Well, the interest isn't deductible. What you're talking about, the mortgage interest would be deductible, but the HELOC interest is not.
No. So unless...
We have to clarify that because it's like a very specific thing, and we're not tax consultants. This is not tax advice.
No, this is not tax advice.
Please seek your local tax and accountant for licensed assistance.
Yeah, but that's actually something that I'm starting to see. So basically right now, a lot of people know that they're in debt.
Can I ask you a question?
Yeah.
Do you have anyone yet that has called you, or do you have anyone yet that part of the refinance is actually removing their mortgage insurance yet? Is that also happening?
I haven't got someone like that yet. No, a lot of it's more like, VA EARLs, cash out refinances. And then the purchase that I have right now is VA new build.
Oh, I do want to mention really quickly about the VA EARL. So first of all, if you're hearing about that term for the first time, it is an acronym because we love acronyms in the military. VA EARL, Interest Rate Reduction Refinance Loan, IRRRL. And it is a streamlined refinance essentially for the VA product. And there's a rule. There's a safeguard for you. You cannot do the VA EARL unless you save 5% a month or more. So you have to at least save 5% on your monthly payment, or you can't do the VA EARL. It's a safeguard so that people aren't getting unscrupulously lent to and basically kind of taking advantage of marketing-wise. Like, oh, come refinance, and your payment changes by $5. Not enough. It's got to change by 5% or more, better for you. So it has to go down by 5% or more, and I love that feature about the VA because people are like, well, why would I do that? Like, well, you don't have to. But there's also a rule that you're not going to just taking advantage of by doing so as well.
No, and like what I said earlier, make sure you're reading your disclosures and seeing what they're charging for the rate that you're getting. Because, you can get the lowest rate, but it's going to cost you a pretty penny.
Yeah, buy down points, discounts.
And speaking about that, I had a client give me a call because 2 months ago they started the refinance process. And they opted to go with a different route. Turns out they gave me a call last week, and they're like, hey, we've been in the process for 2 months. They send me the LE, and the LE is literally the loan amount that they're basically financing. But the numbers just didn't make sense. They were charging him like $17,000 for the rate, and he had a 5.8.
It was discount points, right?
Yes. He was at a 5% rate, and then they raised his rate to 5.01, but charging him $17,000, and the cash out wasn't even what he wanted to do. So when I looked at it, I'm like, bro, this is like very inaccurately, like property taxes. Everything was literally very inaccurately calculated, and that's what I brought up to him. I'm like, hey, like I would just really reach out to them, let them know, ask them these questions, because I never like to knock anybody down and say, hey, they screwed you, they did this. Go back and say, hey, if they're not answering you anymore, maybe that's the reason why. I would have just done this, and that, and I broke everything down to him. I showed him, hey, this is your loan of value. This is how you can go up. So I don't know how they were able to just show you this loan estimate, and it looks great, but obviously that's not going to fly.
Dang.
Hence, they're not calling you back. He ordered an appraisal. He got everything going and basically got straddled out.
Dude, that's crazy.
Yeah.
Wow,
Yeah,
that's
yeah.
unfortunate.
So-
Well, okay. So what are you doing? What are you doing now, though? So that was the situation he came
So
from.
we
What is it that-
restructured everything. We got their loan amount right. We gave them the rate that's actually, you know, what it's supposed to be. It wasn't a 5.875. It was a 6.25. And even like last week when rates got a little bit better, we got them down to 6.125. So a little bit better than what, you know, what it should have been. But
without points, right?
But without points,
so,
exactly.
So the contrast is they were getting like 5 or 5.01% for 17 grand.
So $17,000 was just in discounts, and you still have their property taxes, their insurance, and everything else to basically put into the loan as well.
Right, but that was basically the entry fee to buy that rate.
Yes.
17 grand.
And that's the biggest thing right now, that if you're seeing people advertise low rates, just ask them, how much is that going to cost me?
How much it cost me to
How
get
much
that?
is it going to cost me? Because like I said, anybody could give you the lowest rate. It's just probably not going to be the most cheapest.
You know where I see this a lot in like regular commercial advertising is when you see like new car leases. You're like the new Lexus GS 350, only $499 a month, and you look at the bottom, it's like $7,000 due at signing. Like, wait a minute, hold on, that ain't $499 a month. I gotta pay $7 grand to get it for $499 a month.
So that's
same idea.
Yeah, it's exactly
Same
the
idea.
same idea, because you'll go based like, oh yeah, 5.875, I could get that, great, and then you go into your document, whoa, why is it costing me this much?
Yeah.
But that's, you know, that's the things that, you know, consumers don't really know. And at the time is like, oh, well, this is what it should be. Or I think this is what it's going to cost me. Okay, I have no choice. People don't really disclose it because, you know, sometimes it's like, well, why do I have to pay so much? And they don't want to have that conversation. But I feel that once you're, you know, you're really trying to help people, it's not really about, you know, you, it's more about how you can solve their problem.
Yeah. Well, something to look out for then. So those of you who are doing a refinance right now, make sure you look at your loan estimate and make sure you check for any discount points. Now, we're not going to say that discount points are bad either. Sometimes discount points are the way to secure the best long-term plan by using some of that equity to convert it into something that's more affordable for you. So it's all situation-based. It's very scenario-based too, because here's the other thing, is you still have to qualify for your refinance. So if, in fact, you have to convert some equity into using a buy-down or a discount to get a rate that helps your debt-to-income ratio meet the threshold, well, then you kind of got to do that too. But if it helps you pay off 90 grand of debt, like, that's the give and take. There's something you're going to give up and something you're going to get back, and what you get back is going to cost you something. So just be aware of that.
Yeah.
So, and ask good questions too.
Yeah. And rule of thumb is if you're going to be, you know, buying discount points, at least plan to live in the house for more than 4 years, because that's more or less, and don't quote me, like, you know, don't quote me exactly, but it's case by case.
Yeah, it's very situational.
But it's more or less, you know, a long-term play, because you're going to want that payment to be lower. You're going to be paying for it, and you might not make your money back if you sell the house the next year.
And one of my things I've said off camera, and I think I've said on camera a couple times, but like, if you have to do a reset or a redo for yourself, like, let this be the one. Let's not try to do it 2 or 3 times.
No. Exactly.
I say this very clearly. Like, yeah, we're in business to do loans, and we make money by doing loans, but I don't want you coming back here in 24 months with the same problem financially.
Oh,
like,
100%.
We want you to use this as a fix for maybe a current set of problems. But then if you can move forward in a healthy way, in a healthy patterns, spending wise, so you can avoid this type of bailout, if you will, that's what we really want for you long term.
I think the play right now, and what I'm advising a lot of people that are in, you know, high consumer credit debt, is that make the play where right now you take that equity out, make it work for you, and then take that option once the rates go lower again, and then just bring your payment down again. So it's like you're laying up for that next play, but at least right now you're able to put yourself in order. You know, if things are getting a little bit heavy, like, you have that asset. And I know, you know, a lot of people go against like borrowing against their property, but when it's your last option and that's going to free and clear your path to being able to be free, then I think that's something that you should definitely be considering, or having that conversation with your spouse and family.
Yeah, good, really good, Brian. I want to end on this part of the show because, you know, we actually have to go back upstairs and do some of those deals right now. So we actually have to go and do the deals we're talking about. There has been a massive uptick of refinance activity. So if you are in a position right now where you need to look at your refinance options, or if the recent rate decline has piqued your interest to reconsider buying again, that is also a conversation we'd love to have with you here. You can talk to William, you could talk to Brian, and either one of them would be willing to help you run scenarios and go over some figures to see if refinancing or buying is the right thing for you to do financially. So Brian, we're going to sign off, but what was your favorite part of the show real quick?
My favorite part of the show, I think honestly, this last week with the rates was a real eye opener that, you know, rates will come down. That's not the problem. We just need more inventory. But rates are honestly, like, I think it was very refreshing to be able to give calls to people, like, say, hey, it's time to save some money. Hey, it's time to bring that payment down. Hey, let's put some more money into your pocket. And especially right now with everything that's, you know, on the up, credit card debt, you know, everything being like squeezed. I think these months going into the winter, some of the biggest spending months of the season, savings, utilizing your equity is going to be a big play because, you know, winter's coming and things aren't getting cheaper anytime soon. So I think, you know, you should best prepare right now rather than wait till, you know, it's here.
We didn't go into deep depth about this today, and I'm only mentioning it right now. 1.14 trillion. The new total consumer debt balance just came out last week. 1.14 trillion. That is insane. So my favorite part of the show is actually going over what happened kind of like last week into this week as far as rates are concerned. The 16% mortgage refinance spike is interesting to me because we haven't been able to talk about that a lot. That has not happened, as you saw in that part of the segment 1 of the show. We talked about there being a 59% increase of refinancing this week compared to the same week 1 year prior. That is a really big deal for people financially. I think that we're going to see, I already know, I'm not going to list exact numbers, but we're seeing people save hundreds of thousands, and in a couple cases, over $1,000 a month by doing some consolidation and doing some refinancing. The rates have gotten low. That helps. And they're paying off consumer debt. That also helps. That is a tremendous help to people to, you know, ease the burden in their pocket right now. So really happy about that. 100%. You did a great job today. Thank you for being prepared. And thank you all again for watching the Mortgage Heroes Weekly Podcast. Remember to subscribe to the channel, like this video, send it to someone you know and love to help them win in mortgage and real estate. And also check out our playlist called Friends of Mortgage Heroes. We recently just had Stephanie Russell on, who happens to be my sister-in-law, but is a real estate investor and a realtor who not only can talk about investing in California and outside California, but gave us some great advice and some counsel on the new NAR lawsuit form changes that are going to affect and impact buyers and sellers in mortgage and real estate starting August 17th is the new implementation date
coming
of the new rules.
This Saturday. This Saturday.
That's
Such
right.
a strange time to kind of go into put it out in out there on
Saturday.
On
it's
a
weird.
Saturday, huh?
Yeah.
So interesting.
Anyways, we'll see what happens. Thank you all for watching, and we'll see you again next week.
Bye, guys.